Welcome to our presentation on understanding business finances. Today, we'll explore the key accounts in balance sheets and income statements, brought to you by Easy Peasy Accounting. To grasp the fundamentals of accounting, we use the dealer acronym. Debits include dividends, expenses, and assets, while credits encompass liabilities, equity, and revenue. This helps us categorize transactions effectively. Balance sheet accounts are divided into assets, liabilities, and owner's equity. Assets include cash, inventory, and equipment. Liabilities cover accounts payable and loans, while owner's equity represents the owner's stake in the business. Income statement accounts show how revenue and expenses determine net income or loss. Expenses include purchases, salaries, and rent, while revenues come from sales and discounts. This equation helps us understand profitability. Changes in revenue and expenses directly affect the owner's equity balance. Increased revenue boosts equity, while higher expenses reduce it. This relationship is crucial for understanding the financial health of a business. And that's how we learned about the key accounts in balance sheets and income statements. If you enjoyed this video, don't forget to hit that like button.